One wrong decision today can erase decades of hard work. Not because you are unintelligent, but because you trusted things that were called safe. Warren Buffett, a man who survived every major financial crisis for more than 70 years, is seeing the same warning signs again. He is not speaking to create fear. He is speaking because he has seen too many people get rich quickly and lose everything overnight. As a long-term observer of financial markets, I have deep respect for Warren Buffett. He is a legendary investor who has spent more than 7 decades studying money and human behavior. He never speaks for attention. He never chases headlines. His words come from experience, patience, and the ability to see reality behind shiny numbers. In a recent warning, Buffett said something very serious. He said, the market is showing dangerous signals that most investors are ignoring. If people do not act in time, they may lose what took many years to build. With more than 70 years of investing, he has seen countless bubbles rise and fall. He knows history repeats itself. Only the form changes. Buffett has watched fortunes disappear overnight because people ignored warning signs. And today, he sees red lights flashing in 3 major areas. These are not small hidden markets. They are places where millions of people put their retirement savings and life money. Ironically, these areas are often called safe, stable, and reliable by Wall Street and by many financial advisors. But Buffett says most experts only see the surface. They do not see the cracks forming underneath. He is not someone who predicts disaster every week. He does not appear on television to talk about market collapse. When he speaks, it is after deep research, and this time he sees a dangerous gap between real value and market price. That gap will be corrected someday. And when it happens, unprepared people will suffer most. To explain his thinking, Buffett talks about the late 1990s. During the technology bubble, many companies had no profit. Some had no products. Some had no real business, yet they were valued at billions of dollars. People said the rules had changed. They said old valuation methods no longer mattered. Buffett refused to join the dot-com rush. People called him outdated. In 1999, at a Berkshire Hathaway meeting, he said honestly, he did not understand tech stocks. People laughed. They said the Oracle of Omaha had lost his vision. Meanwhile, others became rich on paper. Stocks doubled and tripled within months. Everyone believed they had found the perfect system. Then the bubble burst. From 2000 to 2002, the NASDAQ fell nearly 80%. Many famous companies became worthless. Trillions of dollars disappeared. People who thought they were set for life had to start over. Buffett said most of them sensed danger, but they ignored it because money was coming in. When profits are strong, people stop thinking clearly. This pattern repeats again and again. Warning signs appear, fundamentals weaken, but crowds keep buying until reality cannot be ignored. And then it is too late. Today, Buffett sees the same pattern in 3 major areas. The first is commercial real estate. Not only office buildings, but the entire system. Banks, real estate funds, pension funds, insurance companies, all depend on it. Before 2020, work life was simple. People went to offices 5 days a week. Companies rented huge spaces. They signed long contracts. They invested heavily. Everything assumed people must work in person. Then the pandemic changed everything. People worked from home. Surprisingly, productivity did not fall. In many cases, it increased. Workers enjoyed flexibility. They avoided long commutes. They worked from anywhere. Companies realized they needed less office space. Years later, office usage is still low, only 60 to 70% of previous levels. This is not temporary. It is structural change Many companies let leases expire. They downsize. They use hybrid models. If demand falls by 40%, what happens to buildings, to landlords, to banks, to pension funds? Buffett says the answer is disaster for those who do not adapt. Vacancy rates in major cities are at record highs. San Francisco, New York, Los Angeles, Chicago, all are affected. These are not temporary spaces. They are permanently empty. When vacancies rise, rent falls. Landlords offer huge discounts. Free rent for years, deep price cuts. Still, many cannot find tenants. Demand is gone. This is when risk becomes dangerous. Pressure spreads through the whole system. From this, we learn something important. Buffett is not spreading fear. He is spreading awareness. Markets move in cycles. Overconfidence leads to collapse. He does not tell people to panic. He tells them to think. He does not follow crowds. He teaches independence. He focuses on real value, on discipline, on long-term thinking. In a volatile financial world, his voice is calm and steady. Fast profits are tempting, but only knowledge, patience, and vision can protect you when storms arrive. From the perspective of a long-term market observer who has witnessed many economic cycles, it becomes clear why Warren Buffett is deeply cautious about commercial real estate. He explains that most commercial properties are built not with real money, but with heavy debt. A typical office building is financed with 60 to 70% loans. The owner provides only 30 to 40% equity. The rest depends on banks. This system works well when buildings are fully occupied and rental income is strong. As long as cash flow covers debt payments, everything seems stable. But Buffett warns this stability exists only when conditions are perfect. When vacancy rises and rent falls, cash flow is quickly destroyed. Suddenly, the building cannot pay its loans, and the financial structure begins to collapse. Then a chain reaction begins. Owners default. Banks seize properties. Lenders try to sell buildings. But buyers disappear. Everyone knows the sector is weak. So buildings are sold for a fraction of former value. Banks take massive losses. If those banks are regional lenders with heavy exposure, they also fall into danger. Buffett reminds us that we saw this in 2023. Silicon Valley Bank collapsed. First Republic collapsed. Signature Bank collapsed. These failures were partly caused by interest rate risk, but commercial real estate also played a major role, and those were only the first dominoes. More will fall. For this reason, Buffett has reduced Berkshire Hathaway exposure to commercial real estate. He avoids office buildings. He avoids retail properties. He is extremely careful when choosing banks. He does not want to be affected by coming losses. He believes this sector will suffer a major collapse, and he prefers to stay away. When the storm arrives, the second area of concern is long-term bonds. This may sound strange. Bonds are considered safe. They are supposed to protect investors during stock market crashes. Many advisors recommend bonds for retirement savings, but Buffett warns this advice may destroy futures. He explains the basic rule. When interest rates rise, bond prices fall. If you hold a bond paying 3% and new bonds pay 5%, no one wants yours. Your bond must lose value to become attractive. With short-term bonds, this is manageable. You recover your money soon and reinvest at higher rates. But long-term bonds are very dangerous, especially 30-year Treasury bonds. Buffett explains that every 1% rise can cut value by 20%. 2% rise means 40% loss. 3% rise means 60% loss. This is not safety. It is gambling, and most people do not realize it. Buffett believes interest rates will rise further, not fall. The reason is government debt. The United States runs a deficit of $2 trillion each year. Spending exceeds income massively, and it keeps growing. Social Security costs rise as baby boomers retire. Healthcare becomes more expensive. Defense spending increases. Interest payments rise as old debt is refinanced. In the past, foreign governments bought many bonds. China and Japan were major buyers. Now they are reducing holdings. They need money at home. They no longer fund American deficits. So the government must find new buyers. To attract buyers, it must offer higher interest. This is supply and demand. More supply, less demand. Prices fall, yields rise. Buffett expects long-term rates to climb, maybe not this year, maybe not next year, but eventually the bond market will demand compensation for growing risk. When that happens, long-term bondholders will suffer heavily. Losses of 30 to 50% are possible. Retirees will be shocked. Their safe investments will be damaged. At Berkshire Hathaway, Buffett keeps fixed income short. Treasury bills, short-term bonds, low risk, low return, but high safety. He prefers small gains over catastrophic losses. What worries him most is that individual investors do not understand this risk. They see bonds in their 401k accounts and think they are protected. They do not understand duration risk. They do not know what happens when rates rise. Some advisors also do not explain. Others avoid the topic. Because they earn fees, Buffett calls this a growing disaster. When rates spike, millions of retirees will open statements. They will see losses of 30 to 40%. He does not want anyone to fall into that trap. A third danger is speculative technology stocks. Buffett is very clear. He is not talking about Apple, Microsoft, or Google. These are strong businesses with solid cash flow. He is warning about hundreds of unprofitable companies, companies without clear paths to profit, companies valued on perfect future assumptions. During the pandemic, a massive bubble formed. Interest rates were near zero. Governments sent stimulus money. People traded stocks at home. On their phones, Wall Street sold everything. New public offerings, hot trends, speculation everywhere. Companies without revenue were valued in billions. Firms burning hundreds of millions were praised as visionary. Any company mentioning artificial intelligence, blockchain, or cloud computing saw prices explode, sometimes overnight, but the bubble burst. In 2022, many stocks fell 80 to 90%. Fortunes were destroyed. Buffett says many investors think the pain is over. They believe speculation is gone. They believe normalcy returned. He says they are wrong. When people forget lessons, history repeats in a new form with the same high cost. Speculation has never truly disappeared. It only went quiet for a while. Then it returned in a new form, and this time, in many ways, it is even more dangerous than before. Look at what is happening with artificial intelligence stocks. Today, any company that mentions artificial intelligence in reports, presentations, or marketing materials often sees its stock price rise sharply. It does not matter whether the company owns real core technology. It does not matter whether its products create real value. As long as it carries the artificial intelligence label, the market reacts. Many companies that were considered finished after the collapse of 2022, that were abandoned by investors, that were seen as having no future, are now rising 3 or 4 times in value. All because they added a few lines about artificial intelligence to their funding presentations. This is not new. Warren Buffett has said that he saw this same pattern more than 20 years ago. During the dot-com bubble in 1999, At that time, any company that added .com to its name was suddenly valued much higher. Businesses that had nothing to do with the internet changed their names, changed their logos, changed their stories, just to look technological. Everyone knows what happened next. The bubble burst, trillions of dollars disappeared. Many investors lost everything. Today, Buffett sees the same pattern repeating under a new name, artificial intelligence. He does not deny the value of this technology. Artificial intelligence is real. It will transform many industries. It will increase productivity. It will create new business models. But he emphasizes one important point. Real technology does not mean every company using the label deserves a valuation of billions. A business that burns cash continuously, that has no clear path to profit, that lacks a sustainable model, cannot become a long-term investment just because it mentions machine learning. In a press release, the basic principles of business have never changed. In the end, every company must make money. They must generate profit. They must produce cash flow. They must create real value for shareholders. A company that loses money year after year is not an investment. It is a gamble. And every gamble ends the same way. When reality catches up with hype, what worries Buffett most is how many speculative technology companies survived after 2022. They did not survive by improving their businesses. They survived by raising more money. They ran out of cash. They returned to investors. They sold more shares. They diluted shareholders. Then they burned more money. The cycle repeated, but the era of cheap money has ended. Interest rates are higher. Investors are more cautious. Venture capital is retreating. Easy funding is no longer flowing. When capital dries up, many companies will have no escape. Buffett predicts that within 2 to 3 years, the speculative technology sector will see a major wave of bankruptcies. Companies that lived on borrowing and dilution for years will run out of options. No one wants to buy a losing business. No one wants to fund a failed model. They will shut down. Shareholders will be left with nothing. At Berkshire Hathaway, Buffett follows a simple rule. He only invests in businesses he understands. He owns Apple because it has real profits, real cash flow, and lasting competitive advantages. He avoids most speculative technology stocks because he cannot value them. He cannot see a clear long-term path to profit. And when he does not understand something, he does not invest. More importantly, Buffett points out that 3 sectors share the same foundation: commercial real estate, long-term bonds, speculative technology. All of them thrived during the era of near zero interest rates, when money was almost free, when the central bank pumped trillions of dollars into the economy, when investors were desperate for yield, when risk was ignored. Real estate boomed because borrowing was cheap. Bonds held value because central banks bought them. Speculative technology surged because waiting for distant profits had new cost. But now money has a price. Interest rates are around 5%. They may rise further. When capital has a cost, people think more carefully. They demand real returns. They accept less risk. They lose patience with unrealistic stories. The sectors once supported by cheap money are now facing reality. Real estate suffers from higher financing costs. Bonds suffer from rising interest rates. Speculative technology suffers from shrinking funding. This adjustment is not finished. The losses so far are only the beginning. The real pain is still ahead. So Buffett chooses defense. He holds more than $300 billion in cash and short-term treasury bills. He accepts lower returns in exchange for safety. He avoids commercial real estate. He carefully selects banks. He keeps bond maturities short. He invests only in technology with strong foundations. he would rather miss the next artificial intelligence craze than lose money in another collapse. And he knows what many people are thinking, that he has warned about bubbles before, that sometimes it takes years for them to burst. But for Buffett, the question is not when. The question is how prepared you are before it happens. How do I know that these three sectors will collapse? The honest answer is that I do not know the exact timing. I have never known the exact moment. And I never pretend that I do. No one in the market can predict the precise day of a crisis. What I do know is the relationship between price and real value. Right now, in many areas, prices are far above business fundamentals. Stock prices, asset prices, bond prices all reflect optimism that is much greater than reality. I also know that the conditions that inflated these sectors are gone. Zero interest rates are gone. Easy money is gone. Excess liquidity is gone. These forces supported speculation for many years. Now they are disappearing, and they are unlikely to return anytime soon. History shows that markets always return to reality. It may take 1 year. It may take 3 years. It may take longer, but adjustment is unavoidable. In investing, I believe it is better to move ahead of risk than to chase it later. Moving early means missing some short-term gains. You may see others making money faster than you, but moving late often means losing a large part of your capital. I know which risk I prefer. Some people think that if these sectors fall, they should simply move money to other industries. That is partly true, but sector rotation must be done carefully. Not every industry is safe. Not every sector is strong. Industries less exposed to commercial real estate, interest rate risk, and speculative technology have better chances to survive. Essential consumer products, like Coca-Cola that I own, generate stable and predictable cash flow. People drink beverages in good times and bad times. Energy companies like Chevron own real assets and produce real cash flow. They do not live on hope. They live on earnings. Insurance companies, which are the foundation of Berkshire Hathaway, actually benefit from higher interest rates. They earn more on their idle funds. That is a major advantage today. When money is easy and speculation spreads, even weak companies rise in price. But when money becomes expensive and excitement fades, only strong businesses survive. For more than 70 years, I have focused on quality. I look for companies with lasting advantages, good management, stable cash flow, and fair prices. This approach works in every market cycle. But it works best when bubbles burst, when weak companies disappear, strong companies grow stronger. The businesses I own will not only survive future volatility, they will benefit from it. I see investing as a game of probabilities. Based on fundamental analysis, no one can predict the future with certainty, but we can identify situations where risk is greater than reward. Right now, commercial real estate, long-term bonds, and speculative technology fall into that category. Their upside is limited because valuations are high. Their downside is large because conditions are changing. These are not bets I want to make, and I do not think you should either. I encourage you to review your portfolio honestly. Look at how much exposure you have. To these three sectors, many people do not realize that their retirement funds contain commercial real estate or long-term bonds. Many people buy bond funds because advisors recommend them. Many buy technology stocks because they fear missing out. They follow the crowd. Without understanding risk, I do not advise panic selling. I advise understanding what you own. Ask yourself, is this risk truly right for me? I have made my choice. I avoid these three sectors. I hold cash. I wait for better opportunities. I focus on high-quality businesses. This approach has worked for 70 years, and I believe it will continue to work. Today, warning signs are everywhere. Commercial real estate is struggling. Bond markets are under pressure. Speculative technology is built on hope, not profit. Whether you listen is your choice but do not say you were not warned. In investing, rule number 1 is protect capital. Rule number 2 is make money. Too many people forget rule 1. While chasing rule 2, they take risks they do not understand. They chase returns they may never get. Then they are shocked by losses they cannot afford. Do not make that mistake. Understand your assets. Understand your risks. When risk outweighs reward, have the discipline to wait. That is what I always do. That is why I have survived every crisis, every panic for more than 70 years. The crowd is often wrong, especially at extremes. When everyone is optimistic, risk is highest. When everyone says something is safe, that is when you should doubt most. Be cautious about commercial real estate. Be cautious about long-term bonds. Be cautious about speculative technology. When price separates from fundamentals, correction is inevitable. Over decades of observation, I learned that crises rarely happen alone. They are connected. They spread like dominoes. Commercial real estate connects to banks. Banks connect to credit. Credit connects to businesses. Businesses connect to capital markets. When one link breaks, others follow. When real estate falls, banks lose money. When banks tighten lending, credit dries up. When credit disappears, speculative companies collapse. When companies fail, investors and lenders suffer. If governments intervene, they issue more debt. More debt means higher supply. Higher supply means higher rates. Higher rates put more pressure on bonds and real estate. That is the domino effect. That is what makes today dangerous. We do not have one bubble. We have 3 connected bubbles. When many things break together, damage is always worse. I have seen enough crises to know that the most dangerous time is when people believe everything is fine. The financial crisis of 2008 was never only about housing. It was about homes. It was about mortgage securities. It was about bank balance sheets. And it was about the entire economy. Everything was connected. And when one link broke, the whole chain collapsed. I witnessed this with my own eyes in the past. And today I see similar patterns forming again. Commercial real estate does not exist on its own. It is tied to regional banks. It is tied to credit systems. It is tied to investment funds. And it is tied to the broader financial system. When its value declines, the institutions that support it are affected. And when those institutions struggle, instability spreads. Long-term bonds are also part of this cycle. They depend on government fiscal policy. They depend on central bank decisions. They depend on global investor confidence. Speculative technology depends on venture capital. It depends on easy money, and that environment is slowly ending. When many weaknesses appear at the same time, risk reaches its highest level. Moments like this often come before serious recessions. And this is when human psychology becomes most visible. When an industry begins to fall, most investors do not analyze. They hope, they tell themselves it is only temporary. They remember why they bought in the first place. They use those reasons to avoid acting. They fear admitting mistakes. They fear realizing losses. So they wait. But when fundamentals have changed, holding is no longer investing. It is only hope, and hope is never a strategy. I have seen this pattern repeat many times. Over many decades, many owners of commercial real estate did not sell when interest rates began to rise. They believed recovery would come. Now they face losses of 30 or 40%. And they still wait. Many holders of long-term bond funds did the same. They were told bonds were safe. Now they wonder if they will ever recover their money. A wise investor does not rely on hope. A wise investor relies on analysis. When analysis shows that fundamentals have changed, they act, they accept losses, and they move forward. There is no shame in admitting mistakes. The real tragedy is letting them grow. I would rather lose 20% today than lose 50% tomorrow. The capital I protect is real money. It gives me future opportunities. Those who only hold and hope often lose both capital and opportunity. Some people say that if everyone sells, the market will fall harder. They say smart investors must go against the crowd. Sometimes that is true, but not always. Contrarian thinking works when prices fall, but fundamentals remain strong. If a great company falls without reason, I am willing to buy more. That is intelligent contrarian behavior. But buying when fundamentals are broken is not courage. It is recklessness, buying commercial real estate with record high vacancy, and is not opportunity. It is denial. Buying long-term bonds during massive government deficits is not vision. It is ignoring risk. Buying unprofitable technology stocks is not innovation. It is gambling. You must know the difference between temporary weakness and structural damage. The three sectors I warn about are not facing short-term problems. They face deep and lasting challenges. When I evaluate any investment, I ask two questions. What can go right and what can go wrong? For commercial real estate, the positive case is clear. People return to offices full time. They can see rates fall, rents recover, values stabilize, but the negative case is stronger. Hybrid work becomes permanent. Offices remain empty. Loans cannot be refinanced. Regional banks weaken. Asset values fall another 30 or 40%. When I compare these outcomes, risk outweighs reward. I do not want to own assets where the most likely result is negative. The same logic applies to long-term bonds. The good case is low inflation, strong rate cuts, global investors return, fiscal discipline improves. The bad case is persistent inflation, high interest rates, rising government debt, foreign capital withdraws, bond prices fall again. For speculative technology, the good case is major breakthroughs in artificial intelligence, cheap capital returns, loss-making companies survive. The bad case is cooling enthusiasm. Investors demand real profits. Funding disappears. Weak companies collapse. Once again, negative outcomes are more likely when risk-reward is poor across three major sectors. The wise choice is patience. Reduce risk. Wait for lower prices. Wait for better fundamentals. Wait for better balance. There is no need to rush. The market will remain. Opportunities will come tomorrow, next year, and many years later, but your capital will not always remain. If you lose half your wealth, you must double it to recover. That is extremely difficult. Avoiding losses is easier than recovering from them. That is why I repeat the first rule. Do not lose money. And the second rule, do not forget the first rule. These three sectors violate that rule today. I am not telling you to leave the market. I am not telling you to hold only cash. I am telling you to avoid overvalued and fragile areas. Many great businesses still exist. They have strong advantages, stable cash flow, smart management, and responsible capital allocation. They will perform well no matter what happens elsewhere. Focus on quality. Focus on value. Invest in what you understand. That is how I have invested for more than 70 years, and that is how I will continue. The warning signs are clear. Whether you listen is your choice. But years from now, when these sectors collapse, you will remember this moment. And I hope you can say that you were prepared, that you understood the risks, that you acted in time, that you protected yourself before the market forced you to